Investing your own money is a big decision, but what does a high level Canadian portfolio manager think about when he makes decisions on behalf of his clients? What are the weightings? What are the asset classes? How does he go about making better wealth decisions for his clients?
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with Ryan Modesto. He's a CFA and a CEO at I2I Capital Management. He's a portfolio manager with I2I, the long-short U.S. equity fund, and he also leads strategy research for 5i Research, which is an investment research firm. Ryan, welcome.
Thanks for having me.
The podcast is about decision-making and in the investment context. And I was wondering if you could maybe talk a little bit about how you go about decision-making, thinking about risk return, diversification, taxes, the whole wide, take a very wide canvas here. Talk to me about how you think about decision-making when you do what you do.
Sure. The whole kit and caboodle. So I think when people talk about kind of investment decision-making, you think it's like one specific thing or this other thing, but we break it down into two called different tiers. So for us, it's between portfolio level decisions and then called the individual security, individual investment type of decisions. I wouldn't want to call it, I don't want to say it's easier, but at the portfolio level, the investment decisions are a bit easier because typically the portfolio decision should trump what's happening underneath the portfolio, right? You work so hard to build your nest egg, build your portfolio up. You don't want to put that whole portfolio at risk for a single investment. So if things happen, say a stock or even a fund of some sort is at a too high of a concentration where your portfolio is becoming a bet on that single security, then your decision's pretty easy, right? You should probably trim it down to some level that you're more comfortable with. The same thing goes for whether that can be at the asset class level, geographic concentrations, industry concentrations, and so on. So you're really looking at your portfolio and just making sure that you're not taking too much risk in any one single area. And if you are, that buy or sell decision, that investment decision is fairly obvious to you, at least in hindsight. And typically, even if you think in most cases, you found a great opportunity that you think is going to do quite well, that portfolio decision should still really trump that individual stock in individual investment decision, because at the end of the day, there's uncertainty. You might think you're right, but you don't know if that stock or fund is going to do what you think it's going to do. So always let that portfolio trump the individual holding so it doesn't make your whole portfolio bet on that single thing.
It sounds to me like you are, to some degree at least, a proponent of strategic asset allocation, that you're not going to go too far betting the farm on a stock, but also on a sector or on an asset class. Is that fair?
Yeah, I think that's certainly fair to say. And it doesn't mean you can't make tilts. And if you think you're really seeing the ball well in a certain area, that you overweight a certain area, certainly if you think that'll work for kind of whatever your strategy is, go ahead and take advantage of that. But it's you need to always just keep things balanced, keep things relatively diversified, we think.
Okay, so let's go from the macro to a slightly more micro perspective. We've talked about not taking big bets and staying diversified. When the time comes to make a decision about what to buy, talk about your focus in terms of bottom-up, fundamental momentum, whatever process you use. What's that look like?
Yeah. So I mean, and obviously there's so many different types of kind of processes people could use. Some people just invest straight on technicals. But for us, it's our bottom-up fundamental investors. What we really focus on is momentum, growth, and quality. So a lot of our, call it screening and trying to find interesting opportunities comes down, like our largest net or our highest signal net is momentum. So we love companies that are trading at 52-week highs, companies that are trading at all-time highs. And a lot of people don't like it because they look at the stock and the stock chart and say, oh, that's up so high. It's why would I want to buy this thing? But for us, it's a really high signal because there's a reason it's trading so high, right? And oftentimes, if other investors are buying a stock at a 52-week high or an all-time high, they're buying it because they think they're saying, we're willing to own something at its highs. And we also think that there's going to be a good return opportunity at this level going forward as well. So it's a really nice, we think it's a high signal type of flag that we keep an eye on. And when you look at the underlying stocks, why do stocks go up over time? It's because something good is happening at the company, right? So oftentimes, if a stock has momentum, it typically means that something good is happening fundamentally at that company as well. So maybe they're deleveraging where the balance sheet is getting a bit cleaner. Maybe margins are increasing. Maybe revenues are growing at a fast pace. Or maybe it's a sector level thing where just something has changed in a certain sector and things are looking good across the board. So we really like 52-week highs. And then that kind of builds our, call it, more urgent type of watch list that we have. And then from there, it just goes down to the fundamental kind of nitty gritty, understanding what the business does, what they do better than their competitors, reading everything available to you. And then once you get comfortable with a company, it's checking those different boxes that you have. It can get you to that sort of final buy decision in a portfolio.
Okay, let's talk about the flip side of that coin. So we've talked about the buy approach. Maybe we can talk a little bit about what you do when you make the decision to sell, or what you contemplate, what considerations you bring to bear when contemplating the possibility of doing a sell.
For sure, yeah. So again, we're talking about the portfolio side of things. It's a bit easier of a decision, right? So maybe a stock it's done really well. It's become too large of a part of a portfolio. So it's time to trim that back, rebalance into something else. Maybe talking about how a certain sector is doing well. So maybe now you're whatever the percentage is, but a majority of your portfolio or a large chunk of your portfolio is in tech now because tech has had a 5-year really nice run. It's probably time then maybe you trim that back, rebalance that tech into something that has other interesting opportunities, or maybe that has underperformed compared to tech. So that sell decision is a bit easier. And there's also a lot of times in year end, I'm sure, John, you've probably dealt with this somewhat recently, is you might be doing some tax loss selling or even realizing some capital gains to offset some losses elsewhere. So those are less security specific, but certainly some sell decisions at the portfolio level to consider.
My experience is that a lot of people do their tax loss selling in December. And then if they've got the winners that they've been letting run that they want to trim because they're getting overexposed, they put that off until January, because then they can delay paying the taxes until the following April. So it's the same. It's two sides of the same coin, but one side is year end and the other side is the beginning of the year in terms of what you're trying to do from managing the taxation as part of a consideration of managing an overall portfolio.
Yeah, for sure. And it's interesting. We always talk about how markets are efficient, but especially in the small and mid cap, you really do see an impact from kind of that year end positioning, year-end tax loss selling stuff. So we've often suggested that halfway through at a 6-month period, just review your holdings. And if there's a chance to constructively realize a loss somewhere, or if you need to realize a gain somewhere, do that maybe at the 6-month mark or even the 9-month mark versus waiting till year end when everybody else is piling in and on the underperformers and you're on your back foot, essentially.
Sure. Could you maybe take a moment to explain the decision between selling to trim your position and selling to exit a position? What goes into those? Because those are two different things.
Yeah. So if you get more down to the fundamental stock reasons, I think there's a few kind of clear reasons why you might want to sell, exit a position fully. So one of them is just simply the story has changed. Whatever reason that you first invested in a company, that reason does not exist anymore. Maybe it's a good thing and that theme or that thesis has been fully realized, or maybe it just never really occurred and it's time to move on from that name. Another one is just simply the fundamentals, right? So maybe you first owned a stock because it was high revenue growth and no debt was on the balance sheet. And now 6 months to 2 years later, whatever your holding period has been, maybe now it's going X growth now. So growth is flatlined. Maybe they've taken on a bunch of debt for some reason. And so that fundamental story has changed as well, right? Versus when you first purchased it. So that might be a reason to exit a position as well. This one, it seems obvious, but I think one of the other reasons to sell is just when you're wrong, right? And it's hard to admit because a lot of times you put so much, obviously, financial capital into a certain investment, but you put in kind of emotional or personal capital into these names as well. The last thing anyone wants to do is admit they're wrong. It's hard to sell, but sometimes it's staring you in the face. The stock is a bit of a dog. The company's just not doing what they said they would, and you just have to cut bait on it and move on. Easier said than done sometimes, but sometimes it's just you had a thesis and it was just plain out wrong, for better or worse.
The consideration in behavioral finance is that's called a sunk cost. And if something is going down, research has shown a lot of people are reticent to sell because if you hold something that's down, it's not a realized loss. It's just temporarily out of favor. But when you sell, and especially if it's trending down with no meaningful reason to think that the circumstances will change, you may as well do that sooner rather than later because you're cutting your losses and minimizing the harm that's being done by hanging on even longer. But emotionally, that's very difficult for many people to do because they don't like to admit that they're wrong. We're human. It's a human tendency.
Yeah. You may have had this great idea, great thesis, but maybe that initial idea you had was off, and that's okay. Right. That's why you hold a diversified portfolio.
And we're human. We all make mistakes. Let's talk about those mistakes. And so we've just touched on one, but there are, I'm sure, a number of things that you would maybe counsel people to think about in terms of the mistakes many investors make. Can you maybe run off 2 or 3 or 4 in terms of things that you think people should be watching out for?
Mistakes. One of the big mistakes we see investors make time and time again is just selling too early, right? Its stock goes up, whatever it is, 20%, 40%, take the gain. It's a great return. You don't get fired for selling your winners, all that kind of thing. Oftentimes it can be such a big mistake. You put in the effort into this certain investment and you've done the research on this name. It's done well. The thesis is playing out. And what do? You cut those gains, the potential for future gains off, right? Oftentimes the stock, again, with momentum, that stock is doing well because good things are happening. More people are realizing or unearthing the story. Fundamentals are moving in the right direction. So you want to hold on to those winners. And what happens if you sell all of your winners too early? You end up with a portfolio full of losers, right? And that makes your portfolio, it makes it a tough situation, that's for sure. So selling too early is often like one of the biggest mistakes we see. And you can't have those big winners in a portfolio, those long-term compounders, if you keep selling them off all the time. And it takes patience, and you're going to see some volatility when you hold on to those winners for a long time, but it can be such a big difference maker in a portfolio.
What about dividends? Different people have different viewpoints with regard to dividends. What's your take on that?
That was literally going to be the next thing I was going to mention. Dividends, I think dividends are kind of like a unique thing to Canadians. Like obviously everyone likes dividends and all different geographies have dividends and all that kind of thing. But Canadians seem to love their dividends, which is fine. I'm not for or against, but I think investors, especially in Canada, are far too focused on the idea of high yield and dividends without realizing that those dividends there's a cost in the sense that it's capital that's not being reinvested into the business. It's capital that's not being put towards other growth projects and things like that. So it limits, in a lot of cases, a company's ability to grow their base of capital because they keep on spitting out those cash flows, those dividends to their investors. Certainly a chunk of a good kind of having some dividends in a portfolio, makes tons of sense, but we think we far prefer growth. We're far more growth-oriented types of investors anyways. We're not, call it, huge fans of dividends in general, but we do think a lot of investors focus a bit too much on dividends and miss other good opportunities simply because a name isn't producing a high yield for them.
I've got a couple of stories I can tell you with regard to dividends, anecdotes that I can plug in to drive the point home. Some of the people listening will know that I have mentioned this a couple of times in the past, but there's a theory of dividend indifference with regard to how people allocate money within a corporation. So a couple guys by the name of Merton Miller and Franco Modigliani won a Nobel Prize with regard to dividend indifference. And their view is if you've got two companies that are otherwise identical, and one of them is paying a 4% dividend, the other one's not, and the one that's not is earning 8%, what is returning 8% over a long time CAGR, compounded over, let's say, a decade. But the other one's paying a 4% dividend. What would you expect the CAGR for the one that's paying the 4% dividend? And of course, the answer is, well, it's 4% because they're identical companies. And the total return is going to be identical. It's just that one is an 8% capital gain, and the other one's a 4% capital gain combined with a 4% dividend.
Yeah.
And now it becomes a question of personal preference, and which leads me to the second point as an example, because as you mentioned, Canadians love their dividends. But you know who's not so keen on dividends? Warren Buffett. So over at Berkshire Hathaway never pays dividends because if you pay dividends, they're going to pay tax on the distribution. But if you let it grow and on a tax deferred compounding basis, you don't pay tax until you sell. And so if your holding period is, in Buffett's case, he'll say it should be infinity the rest of your life, then you can defer your taxes for infinity. And that's the sort of thing where if it's really about building wealth, then Buffett would make the case that dividends are actually antithetical to building wealth, because dividends manufacture a tax liability that could have been avoided if you simply didn't pay that dividend.
For sure. Yeah. I think the one benefit for where it can be a benefit from a psychological point of view is if getting a certain yield on your, for the end investor, if getting a certain yield on your investment, if that's what makes you and helps you hold on to a investment for the long term, then it's probably doing more benefit than damage in that kind of case, because it's like classic. Maybe it's drifting down a certain amount, but at least I'm getting my dividends, so I'll hold on to it. That can be a good thing. Now, it can also be a bad thing because maybe it makes you hold on to a bad stock for longer than you should as well. But so that's one benefit to it. But also at the corporate level too, a reasonable amount of dividends keeps the management team honest as well, because they know that, year in, year out, quarter in, quarter out, they have a certain level of cash flow in the form of dividends that needs to be paid out. So they're not going to, in theory, it's going to keep them more honest. They're not going to go do big irresponsible acquisitions or something like that. But again, I don't know what that line is, but there's a fine line where too much of a dividend, it constrains the business and stops them from reinvesting in their own business.
One of the things I've heard you say in the past is that it's a mistake to sell because insiders are selling. Can you explain why you feel that way?
Yeah. So at the end of the day, there are 100, maybe 1,000 reasons someone might be selling their shares, right? Maybe they're going through some personal family strife. Maybe they're buying a new house. Maybe they have a big tax bill they need to pay. Or maybe they've just, whatever the company is in question, maybe they've just done really well on it and they don't want 100% of their portfolio concentrated on this single company that they work at day in, day out kind of thing. So there's so many reasons that an insider might sell their shares that we don't think there's a whole lot of signal there. Where there is signal, though, is if investors are buying their shares on the open market, if insiders are buying their shares on the open market, because there's only one reason you're really doing that, right? And you're doing that because you think the company is going to increase in value. Where I think the insider selling can be a bit more, you can get a bit higher signal, is if you're seeing a really large sales on the open market by insiders, and you're seeing across the board selling from insiders as well. So everyone on the management team is selling their shares. Then yeah, you might want to pay a bit more attention to that. But in general, insiders every day, week, month are selling shares at the majority of their companies regularly.
Sure. Okay. Let's talk about weighting decisions. So we've got a long-term strategic asset allocation, and you've got X amount in this asset class or in this sector and Y amount in the next. But it's often under discussed, and the decision about how to weight your exposure to a given investment is obviously one of the many important decisions that you have to make when you try to make your wealth decisions. So maybe walk us through what you think about when you do your target weightings.
Yeah, it's interesting. Like it's always talked about like it's such a binary decision, right? Yeah, it's like you fully buy or you fully sell, but there is the whole weighting decision that goes in between, and it's probably a more of an important decision than the actual buy sell decision in a lot of cases, right? Maybe you found the best company ever and you've invested in it, but if you're holding it at I won't give an actual percentage, but a really low percentage of your portfolio, even if it does well, it's probably not going to do a whole lot for your portfolio. And vice versa, if you weight a bad name too much, too high of a weighting, it can really hurt your kind of returns going forward. So for whatever reason, it's something that doesn't get talked about a whole lot, but it's something I think that investors should probably pay almost the most attention to. There's a bunch of different approaches you could take to how you would weight companies in a portfolio. We go with more of an equal weight approach. We hope that we can find a handful of companies that we think will outperform over time. But we don't necessarily want to try to also then rank those names that we've found and try to decide which ones are going to outperform of the ones that we think we're going to outperform, kind of thing. So it's like adding an additional hurdle onto your investment process, we find. So when you equal weight it, it allows all of those names you've found to contribute if they work out to contribute meaningfully to your portfolio, to your returns. Meanwhile, at the equal weight, it also limits the risk of a single name really hurting like getting too big and hurting the returns of your portfolio as well. So that's just from a style perspective, we've always gravitated more towards the equal weight, and we think it works a bit better. And then we like to view them as two tiers essentially. There's a type of stock that's gonna be, call it equal weighted at a lower weighting, and then a type of stock that's gonna be equal weighted at a higher weighting. So typically nobody likes volatility that much unless you're really confident that you can pick up shares at a better price and ride that storm out. But typically you'd maybe want a higher weighted name in names that are more stable, typically higher market cap, more proven business. So just that, so you can hold it at that high weighting, and it's not going to fluctuate a whole lot where you're going to get spooked out of the position. And then for names that are maybe higher valuation, maybe a bit smaller, or maybe just more of a growthy name that's going to be more volatile, you can still hold them at a meaningful weight, but you're probably going to hold them at a bit of a lower tier than those larger, more stable names, just because maybe they'll move 10% any given month or any given week. And if you're holding at too high of a weight, it's going to be hard to make the right decisions at the right time. If you hold it at that kind of more manageable lower tier, you'll probably be able to ride those ebbs and flows. And it also gives you an opportunity, if it gets into a big drawdown for whatever reason, you still want to own it, you probably have a bit of capital where you can add to it at that point, versus being too high of a weighting and you're not, when it goes down, you don't have the capital or the ability to add to that name at that point.
This has been a great overview. I've really enjoyed this because a lot of what we talk about, usually my guests will talk about things that are maybe a little more high level, and your thoughts have been perhaps a little more granular with regard to how you sort through various companies and make your decisions. So thank you for all that. I want to ask you the question I always ask people at the end, which is, this is about making better wealth decisions. So what advice would you give to the people listening today to help them make better wealth decisions?
What's worked for me and what I've always believed in is just start investing as early as possible. And if the best day to do it was yesterday, if you're not investing, do it today kind of thing. And it doesn't matter if I don't care if it's passive, if it's active, if whatever you're doing, just save as much as possible so that you can invest as much as possible in the markets, because you can tell people, scream at the top of a mountain that the power of compounding and how just even little bits of amounts that are saved and invested and grow and how they can be life-changing. You can say it, but you don't really get it until you see it happen. So you just got to do it, save as much as possible, continually invest, and just think long-term, and then things should work out over time.
Thank you so much, Ryan. It's been a real pleasure.
Thank you.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387, or at jdegooey@designedsecurities.ca.